It's accelerating our ability to adjust, to live with the virus. Is that the silver lining here?
It is. The fact that deaths haven't gone up is important. That's vaccines. Hopefully, behaviors will also be a little bit more cautious than they have been in the past so that we can continue to live with it. Look, it's not going away. We have to understand that. It's not going away anytime soon. So unless we learn to live with it, we're going to be vulnerable to disruption. John, the one element about this Delta variant that's not being covered enough, if I may, is what's happening on the supply side.
Yeah.
There are a fresh new round of supply disruptions in Asia, Vietnam, China, ports being closed. It's hard to transport things. That is going to have an impact on the supply side, making a supply problem even worse. So keep an eye on the supply side. It's not just a demand issue. It's even more importantly a supply issue.
Mohamed, build on that. Do you think there is a risk of a second wave flushing through supply chains, given what's developing in China at the moment?
Yes, absolutely. I mean, talk to companies. They first saw it in Vietnam, they saw it in India, and now it's happening in China. Tracy Alloway of Bloomberg put out a tweet about what's happening to ports. Certain ports in China are shutting down. That is going to have an impact on the global supply chains. So if you are a U.S. company, you're looking at higher wages, if you can get the workers. You're looking at higher input costs, and you're looking at transportation costs also being problematic. All that is still in the pipeline. We haven't gotten through yet the supply disruptions. That's why the inflation narrative has to be open-minded.
That's the analysis on the economy. We need to also talk about how the Fed's going to respond to this. Fed speak through the week. This from San Francisco Fed President Mary Daly. She said the following in the Financial Times. It's appropriate to start discussing dialing back the level of accommodation that we're giving the economy on a regular basis. And the starting point for that is, of course, asset purchases. Let's get to our good friend Mike McKee for a little bit more on this. Morning, Mike.
Good morning, John. Well, the Fed has spoken and spoken and spoken. Mary Daly, not the only one who has been speaking. We've heard from 15 of the 18 members of the Open Market Committee, and there does seem to be some division. It may be narrow, but there are three groups that have sort of formed. The "we're not there yet" for an announcement camp, and that includes Jay Powell, the chairman, John Williams, the vice chairman of the Open Market Committee. Then you look at the "announce this fall" group, and that includes Mary Daly, also Rich Clarida, Raphael Bostic, and Thomas Barkin, who are voting members of the committee. And then you've got the "start tapering now, we're ready" Chris Waller, Rob Kaplan, Jim Bullard, and Pat Harker. So the division into three groups makes it kind of hard to see how you would get Jay Powell giving a sort of unified message at Jackson Hole. It might be the September meeting when they have to iron all this out. And once they decide when to announce it, then the question is, how fast do they taper? That's another division. You can see the red there, that was the taper after QE, the great financial crisis. And you can see when that took 2 years and they got done with it, and they had to start raising the amount of assets they had because they'd gone a little bit too far. So do they take 2 years? A lot of people say, no, let's get this over with in less than a year. Rob Kaplan says in 8 months. I want to leave you with one thought here. This is a hedge that has come into fore in the last week. The debate on raising rates will follow once they taper. Too early to start betting on when that is, but apparently not too early to start hedging against it. A run on Eurodollar options betting the Fed won't raise rates at all. 153,000 open positions on this week after 22,000 a week ago. So, John, you and Mohamed can discuss this idea that somebody out there is worried that they might lose money.
Oh, that's the market.
If the Fed were not going to raise rates at all.
We can chew on that right now. Mike McKee, thank you very much. Mohamed, it just raised the question, the likelihood the Fed does a Japan, does a Europe. What is the likelihood of that happening?
So there's another likelihood that's also in that trade is that they start tapering, they start raising rate, and it turns out that the economy can't take it. And then you get a recession because they are late, and then rates come plummeting down. John, I think what's interesting is not only the three camps that Mike just pointed out, and I took pictures of them, by the way, because I intend to tweet them out. It's great graphics. But it is the direction of travel, and the direction of travel is unambiguous. More FOMC members believe that an earlier taper would be a good idea. Does that matter to the markets? No, because the big ones have not felt that way. And until Powell or Williams shift, this market is going to be very comfortable with the notion that the Fed was going to be supported for a very long time.
Mohamed, something slipped under the radar for a lot of people this week. You were on top of it. It were the words of Boston Fed President Eric Rosengren. And I want to bring you the quote for our audience, and it read as follows. This was with the Associated Press. If you continue to purchase assets, the reaction primarily is in prices, not so much employment. I don't think asset purchases are having the desired impact on really promoting employment. Mohamed, this is really rare for someone on the Federal Reserve to question the value of QE. That's different.
It is, and I tweeted it out because President Rosengren in particular is highly respected for saying it as it is. He comes from a research background, and he has a very direct communication style. And for him to say QE simply works on asset prices, doesn't work on the economy, is a big statement. But as you said, it flew totally under the radar. And it just shows you the conditioning of this market. This market is so deeply conditioned to believe two things: that the Fed is going to be our friend forever. I call it the BFF. And secondly, that there is no alternative, as you started out our interview, that we will brush aside as a marketplace until there's overwhelming evidence. And the question is, what does that overwhelming evidence look like, and when does it come? And I don't know a single person who can answer that question confidently.
Well, let's wrap things up and put a bow on it, and end with some behavioral psychology, behavioral finance as well, Mohamed. The conditioning we've seen, what changes it? Is it the drip of water torture or a major catalyst? What changes something like that?
I think it's going to be one of two things, John, or God forbid, a combination of both. One is clear evidence of a policy mistake. And if you get clear evidence of a policy mistake, then the paradigm changes completely. Suddenly, people will listen to Bill Dudley much more closely and worry about that outcome. The other one is a market accident. You know, we are seeing more and more risk-taking that's being rewarded, and the more it's being rewarded, the more it's being encouraged. At some point, margin debt is going to get too high. At some point, leverage is going to get too high, and then you're going to get some sort of market accident. Now, I don't know what the timing for this thing is. It can be weeks, it can be years. We don't know. But what is very clear is that the market is all on one side. So if ever that happens, it's not just going to be the inherent risk. It's going to be liquidity risk that you're going to have to manage through.